So 2023, how much volatility in bonds? I mean, I feel like this is the year of fixed income to, you know, the good or the bad side.
No, I still think it's a year of fixed income. So I do think bonds are back. Yields are higher, often negative, zero rates. These are all very positive items for sure. But there's still a lot of work to do, and volatility will be here for a while. But we're coming off of a much higher yield level, so it covers a lot more mistakes.
So, Greg, what are you buying right now? If you look at your ideal portfolio, let's say 2 months from now, and then longer term to the end of the year, is it different?
It is. So I think it's too early to go deep in risk, deep cyclical type of investments. We see a lot of value in structured products. We see a lot of value actually in the front end. You're getting a lot of carry. So we think it's a market to take what's given to you, and there's a lot being given. And so it's not a place to go into triple C's, levered loans, all these types of areas. It's a much safer environment for bonds, and we're just taking the carry and roll.
I don't know how you look at the inverted yield curve. I have at least one or two viewers every day that send me a good chart on this. Like, what do you think it shows us?
Well, what it shows me is that something needs to be reconciled this year, and I think that's the source of volatility. You can't have an inverted yield curve and expect risk assets to do well. So what I worry about in terms of 2023 is actually we achieve this soft landing and the curve starts to normalize, and that's the catalyst for the slowdown, because there's so much borrowing off the intermediate to back end of the curve that could actually be the hit to consumers. That could be the hit to corporations ultimately. So it bears watching, no pun intended.